Futures turn lower after a miss on the non-farm payrolls. 30 minutes until the start of cash trade. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, payrolls missed estimates, but not as much as feared. We're going to get the reaction from the White House economist, Kevin Hassett.
Next up, Fed Chair Powell takes the mic as President Trump's policies inject chaos into the economy and the markets.
And Broadcom delivers an upbeat outlook, reassuring investors that AI spending remains on track. Broadcom shares up 8% pre-market, but you wouldn't know it by looking at the indexes right now. It is all about that jobs print. Let's go there right now. We saw a little bit of a lift after the numbers. We missed expectations, but just so, adding 151,000 jobs. At first, the narrative was, okay, maybe this is good enough to draw a line under those growth concerns, but now you can see those fears re-emerging in the pre-market trade. The S&P 500 down about 0.2%. The Nasdaq 100 also giving up its pre-market gains, pretty much unchanged right now. The bond market has been telling the same story all morning, though. Yields shot up after that 8:30 print, and they remain there, with the 10-year Treasury yield higher by about 7 basis points. But we're camped out at about 421. You compare that to where we were a couple of weeks ago, it's pretty shocking.
Yeah, our survey of economists was looking for 160,000. The Wall Street Journal survey was looking for 170,000 jobs. So the loss looks bigger if you look at different surveys. This is ECAN-GO, E-C-A-N-GO. You can type it in on your Bloomberg terminal and get a wealth of data that breaks down into really granular detail. Over the last year, you can see we were up and then down. This looks like a little bit of a rebound. This box here is government jobs. And if you click into that, you can see the breakdown. We've lost, yellow is federal jobs, about 10,000 there, but we've added, green is state jobs, about 21,000 there. And economists expect that yellow box to grow bigger and bigger and bigger as Doge takes effect in the coming months.
I am very impressed with your charting today, I've got to say. It's not even nerdy. It was too many cool colors for it. He's gonna hate me this morning. Broadcom, as Katie was saying, is up. Looking at some stocks moving under the surface, 8% pre-market, the most in really 3 months after delivering that upbeat forecast, strengthening AI demand. Remember, Broadcom had been selling off with the wave of bad news we had seen from some of the rivals, or upsetting news, now bringing some of the love back. HP Enterprises warning of weaker profits, though, and margins. You have Hewlett-Packard Enterprises down more than 16% pre-market. They're also citing uncertainty around Trump tariffs. We've been hearing a lot from companies on that this week. Finally, the Gap is rallying on earnings. They posted stronger than expected sales across most of the major brands at the retailer, up more than 14%. Time to buy that Athleta, apparently, to go running this weekend, Matt. I heard that there are a few cans of ice cream and Rice Krispie treats that we were nibbling on this week.
You haven't been, though, buying enough Athleta, because that's one brand that saw a decline in same-store sales. We're going to get into that, but of course, it's the non-farm payrolls number that really stands front and center. And Katie, the interesting thing is, and we're going to talk to Mike McKee about this in a moment.
He's sitting to my left.
You only saw 10,000 job losses on the federal level, and we've all been watching, Sonali especially, these Doge job cuts so closely, but they really came too late, or the survey was too early to include them.
Yeah, well, plenty of economists would tell you, don't worry, those are coming. I thought it was interesting, though, we were talking about the headline number coming in just below expectations, but there were downward revisions to January's print as well. And we heard from Scott Besson 30 minutes, an hour or so before these numbers came out, basically warning of this detox period for the economy. Kind of prescient.
That doesn't sound good. What's a detox period?
You know, Katie and I were talking. It's not good. But the message from the administration has clearly been, take your medicine. It could be painful for a while. Bear with us. Really, it's a patriotic duty to bear with the losses in the market that we're seeing into March.
Yeah, specifically, he said, look, there's going to be a natural adjustment as we move away from public spending, that this market and the economy have just become hooked. We've become addicted to this government spending. There's going to be a detox period, and maybe that's to come. So to be clear, it's good on the other side of a detox, but while you're in it,
it hurts.
It really sucks.
But you know, it's interesting. It's the worst week for the S&P since we've seen since at least September. Even if we rebound today, it's going to be the end of a tough
Yeah,
week.
we're down 6.5% from our highs on February 19th. On the Nasdaq, we're down 9.5% from our highs, so almost in correction territory. And I guess we should talk to Mike McKee.
Yeah, let's get to these numbers. Let's dig deeper with Bloomberg's Michael McKee. You know, to the point on the job cuts, the federal job cuts, how much anxiety does that put on the upcoming jobs report? I know that today you had the estimates all over the place from as low as 65,000 to well above 170, as Matt was saying.
It's going to be hard to know. Hopefully we get some detail by that time. The problem is we keep hearing about people getting fired, and then we hear about people getting rehired, and there's just no clarity yet. So we'll have to wait for that next jobs report to see what's happening in the federal government. On the overall scale, the numbers are still pretty good. The Fed thinks you need around 100,000 or a little less as your replacement figure for people who leave the labor force. So 151,000 is not a bad report at all. And the revisions for both December and January put together were very, very small. The unemployment rate did rise a solid 0.1%. There were more people who were unemployed in the household survey than who were employed. Average hourly earnings, probably a mix of who was hired and who was not and who was unable to work. And hours worked did not change. It fell from December. And there have been people who are thinking that maybe that's a sign that the economy is slowing down a little bit. We'll see. Most jobs created, education and health, that's always the case. Wasn't the case in ADP, but it's always the case. And then in construction, which is a little bit odd given the weather that we had, and finance added 21,000 jobs. It was all those people who wanted to be able to get tickets to Sonali's Invest event. Most jobs lost. Leisure and hospitality, that's weather. Retail, interesting there, drop of 10,000 in Colorado strike against a grocery chain that will be added back in. So that's something.
10,000?
10,000. So that's why we have to figure out, to make it harder to figure out next month. I mentioned weather, unable to work. 404,000, that's down from January, but it's still a very big number, which is normally what we see this time of year. But I did make one last chart for Matt, because I knew he would love this. Climate change. When you look at the number of people who are unable to work on a month-to-month basis, you normally see in January or February, you can see those spikes. That's the bad weather. But look what we've got in the lower right-hand corner there. That's the last year. We've had a lot of weather events this past year. And you throw that on top of the COVID rebound and things like that, and the data get very hard to predict.
All right. That is really fascinating, and obviously the weather events seem like they're coming faster and furiouser. Mike McKee, thanks very much for that. Gargi Chaudhuri, BlackRock's Chief Investment and Portfolio Strategist for the Americas, joins us now with her reaction. Gargi, first off, what did you think of the jobs number?
Good morning. It's good to be here. How are you guys? So jobs number, a couple of things. Number one, I think that obviously given expectations, it was a little bit softer, but nothing in that job number makes me think there's any fear of recessions that are screaming through this number. Number two, no large indications of broad-based departures for people in the job market. So I think that's a really good sign. And number three, if you look at the 6-month average, the 3-month average, all around that 192, 200,000, and today at 151,000, you're looking at a moderation, which I think is a good sign. So nothing here that screams recession, and at the same time, no broad-based job destruction quite yet.
I hear what you're saying, that you take a look at the February numbers. You don't see anything that really gives you pause. But what people are worried about is the look ahead, Gargi, as you know well. You've seen inflation expectations rise. Growth fears have been sort of the name of the game over the past couple weeks. It sounds like what you're saying is maybe we don't need to be so breathless there.
You know, we've received a lot of data over probably the last sort of 5 to 6 weeks that have brought this fear around, I'll call it slowflation, not quite stagflation, but certainly a slowing growth picture. But I want to remind everyone that we came from a very solid underpinning of U.S. economy, right? So when you look at the Q4 data, when you look at the Q4 consumption, that was really strong and solid. So a little bit of softness here in the first quarter is perhaps par for the course. Obviously, the equity market, as we were talking about before, as you guys were talking about, is having a pretty a soft week. And again, this is where a little bit of a pullback from such strength over the last 2 years, I think is a healthy, needed pullback in the market. So as of now, slow down. Some signs of inflation for sure. We're telling investors to add hedges around here, and we can talk more about what those look like, but certainly nothing that screams a massive slowdown on anything that even resembles the R word.
Gargi, to the extent you're telling investors to add hedges, what is the biggest risk from here and how much downside is there?
So, we're all getting used to the day-to-day or week-to-week shift in the tariff narrative. But what I'm telling investors and clients to keep their eye on is what's the end goal? Where might we be in 3 months and 4 months? Could we see inflation a little bit higher than here? And I think the answer is yes. And in that case, adding some hedges, especially around shorter-dated inflation-linked bonds, where investors have been leaving the TIPS asset class. And I think bringing that back into your portfolio make a lot of sense. Number two, there might be some added volatility in the U.S. equity markets, especially over the next few months. We've had a very strong macro narrative in 2024. This is going to, and this has already been the year of micro narrative shifts. There's going to be news stories all week, every month. So adding minimum volatility, perhaps strategies, and again, staying up in quality in large cap space. And then the last thing I'll say is this is the time that investors might want to think about adding income. Fixed income is back, and we think that fixed income is going to continue to be a really good provider of ballast, provider of income in your portfolio.
Even without a recession, fixed income makes sense. Gargi, we have to have you back soon. Not enough time. Our big thanks to BlackRock's Gargi Chaudhuri joining us on this Jobs Day. Now coming up, White House National Economic Council Director Kevin Hassett joins the show. You don't want to miss it. This is Bloomberg.
Live from New York City for our audience worldwide on TV and radio, I'm Jonathan Ferro. Joining us now, I'm very pleased to say, is the National Economic Council Director, Kevin Hassett, following the jobs report earlier on this morning. Kevin, welcome to the programme, sir. It's always great to get your thoughts. I just want to take a beat and take a big step back and just think about where we are and the moment we're in. This is what we've heard from the administration over the past few days. The president has said there will be a little short-term interruption. The Treasury Secretary, Scott Bessent, spoke this morning and said there's going to be a detox period. You said last month the jobs market was worse than markets thought. What exactly are you, together with other officials and the president, this administration, what are you preparing us for?
We're preparing you for news like today, the great jobs report. I think one of the things that you see, if you look at it, is exactly the objectives of the Trump administration, and the fact that even though we got a lot of work to do, we got to pass the tax cuts and get this deregulation train rolling, is that we're going to be reducing government employment and reducing government spending and increasing manufacturing employment. And as you can see in the jobs report today, you're already seeing a pivot in that direction. That's a huge one. And so last year, 111,000 manufacturing jobs were destroyed by the Biden administration's policies. And in this month alone, in February, we got 10,000 manufacturing jobs and 9,000 auto jobs. And as you know, those auto jobs are, here, they're going to be paid well, and they're here for a good long time. And that's really just sort of a down payment on the Trump policies that are going to skyrocket into a golden age as soon as we get the tax cuts passed.
So, Kevin, I hope you're right, but what I've heard over the last week or so regarding the economic data, when I spoke to the Commerce Secretary, Howard Lutnick, Secretary Lutnick said that this was Biden data over the last month, that this was not Trump data. So if it's good, is it Trump data? And if it's bad, is it Biden data? How does this work?
Let's go into the specifics. So what specifically has happened is President Trump has made a big effort, along with Elon Musk, to find workers that are unproductive and to get them off the payrolls. And so we see government spending going down. So is that a Trump effect? Yes. Manufacturing and job creation in the auto sector is happening because people are anxious about future tariffs and they're already onshoring production. Is that a Trump effect? Yes. But it's true that we've inherited a lot of terrible Biden policies. They want to, get expensing gone and so on, and that's bad for capital formation. We're going to fix that. So we haven't fixed everything, but already the of things that we're fixing. You can see in the data, and I think it's really quite remarkable.
Well, let's talk about the manufacturing data as well. We had that over the past few weeks. You're familiar with ISM manufacturing. You're familiar, I'm sure, with the respondents in the surveys, and this is what they had to say. The uncertainty about tariffs keeps us cautious on spending. Customers are pausing on new orders as a result of uncertainty regarding tariffs. The incoming tariffs are causing our products to increase in price. Are you hearing the same message from businesses? Are you hearing something different?
Yeah, what I'm hearing is a massive amount of onshoring. We've got more than, what, $1.5 trillion in commitments for new factories, and you're already seeing it in the auto data. I mean, think about it, how hard it is to create a job in the auto sector. To have 10,000 in a month means that the attempt to onshore activity, to make it so that the jobs are created here and the money isn't just, frittered away to foreign countries, is exactly what President Trump's objective is, and it's right there in the data. Now, I know that it's 1 month and the data can blip around, but I was really, really stunned. And the other thing I was stunned about, which I know you guys follow this a lot. In fact, Anna Wong at Bloomberg is one of the best young economists I know at looking at the numbers, is that it was a really bad flu season. And so when I adjusted for the flu, what I thought this number was going to be, it was way below the number that we got. And so I was very positively surprised by this number once you adjust for flu. And then you see that all these jobs that are created in manufacturing. And finally, if you go back and look at the Biden job record, mindful of the fact that they revised it down 1 million jobs last year, don't forget that a lot of the job creation was government workers. It was government workers. About a quarter of the job creation over the last 2 years was an increase in government workers. And so if you take those out and then still have a strong jobs number, that's a great economic outcome.
I'm pleased you're in a good mood, because that's refreshing. Because I have to tell you, over the past week or so, Wall Street is full of a lot of gloom right now, Kevin. I'm sure you've heard some of it. So here's some of it for our audience and not just for you. Barclays say US recession no longer unthinkable. Morgan Stanley this morning downgraded growth forecasts, upgraded the inflation outlook. And this is the why. This came from Deutsche Bank. Another talented economist, Matt Lazzetti. Considerable downside risk to the growth outlook are mounting. Trade policy uncertainty has hit historical levels. Financial conditions are tighter. Sentiment indicators signal weaker growth, and more trade actions are likely to come. Kevin, the people that we've been speaking to want clarity on trade. They want to understand that maybe in a month or so this will be done, whether the tariff is 10, 15, 20, 25. When can they expect that much needed clarity?
Oh, absolutely. I think in some sense that you've got quite a bit of clarity already. There's no uncertainty. There's going to be some tariff. It's going to be reciprocal. If you don't like tariffs very much, then reciprocal could be a great thing for you, because then countries around the world will be lowering their tariffs. But the president believes that if we replace income tax revenue with tariff revenue, it can make everybody better off. And so if we take $1 away if you buy a foreign good and then give you $1 back in an income tax, you're going to be better off, is what he believes. And I think what's going to happen is that markets are going to watch numbers like the numbers we see today, and they're going to gradually see that President Trump is right. This is how you build a golden age.
All these companies are going to be worried about what's still to come, and will hold off on making these decisions because they don't know what policy actually is. A month from now, we'll get more detail on tariffs on the likes of the Europeans. We'll also get an update on what's going to happen with Mexico and Canada. Kevin, can you share with us whether the president has provided any metrics to the Canadians, to the Mexicans, on what they need to get done between now and next month?
I can tell you that we've been in the Situation Room looking at the very best info we could get from our intel agencies on the progress that's being made on the drug war. And that's what this whole Canada-Mexico thing is about. It's about a drug war. And there have been some parameters that have moved because it's an active negotiation. And President Trump is seeing progress of the drug war, both in Canada and in Mexico. And he's, in the end, trying to save the tens of thousands of American lives with this drug war. And that's why he's adjusted when he's seen progress. But yeah, we've got people, satellites and everything, looking at where the fentanyl labs are. And we're making progress. And I think that that's separate from what we're going to see in April, where uncertainty will be resolved because we'll have a report on the Reciprocal Trade Act.
The European issue is different. You've been clear about that, and I think we all understand it. There's been a big change this week over in Europe, and potentially in the months and years to come. The Germans are getting ready to spend on infrastructure and on defence. Do you and the administration like what you're hearing from the Europeans in the past few days? And do you think that would lead to a different approach when it comes to tariffs in the next few months?
Right. Absolutely, the Europeans need to make a lot of progress on defense. They've been free riding on America for a long, long time, but they're our friends. That's a foreign policy issue. But on an economic policy issue, think about it this way, that in a typical month, we're importing about $35 billion worth of autos and exporting about $13 billion worth of autos. And that's because of all of the non-tariff barriers and tariffs themselves, like the Europeans have a 10% tariff on autos, that President Trump's views as unfair. And so against that backdrop, the idea that we created almost 10,000 auto jobs this month shows that he's on the case, and he's fixing these things that are unfair for American workers, and he's making progress already in February.
Kevin, do you think the reciprocal tariffs, the focus of them, will be on autos, or is it much broader than that?
Oh, it'll be much broader than that, yeah. We basically want trade to be fair for Americans across everything,
Kevin, as you know, there's been some jitters on Wall Street, so let's finish there. In the equity market, we've seen a pullback of 5-6 percentage points. Not too dramatic, but there's certainly some fear out there, and you see that in sentiment indicators. Traditionally, with the Trump administration, particularly in the first term, we became accustomed to what became known as the Trump put in the equity market. Secretary Bessent says there isn't one anymore. He says it's all about the upside, and there's a big call. I understand that. But the president said just yesterday, I'm not even looking at the stock market. Kevin, what is the president looking at? And if I can leave the interview here just with this final question, what is his metric for success through this year? What's that number one data point that we should be judging this administration by?
Well, I think that obviously when you're looking at the economy, there are lots and lots of different things that we care a heck of a lot about. For the drug war, the thing we care about is reduction in deaths of fentanyl. In the economy, what we want to do is see a creation of manufacturing jobs, especially auto jobs. And we want to see a successful tax bill. And I think that all of that is going to give us the 3 or 4% growth that we're all hoping for, that we got in the first term, and that we'll get again. But I think that just picking one metric is not enough for the president. But I can tell you that last night when I was in the Oval late at night talking about the jobs numbers with him and telling him about the 10,000 manufacturing jobs and 9,000 auto worker jobs, he was really, really pleased to see the numbers.
Kevin, we're pleased to catch up with you. Appreciate the spirited conversation, sir. Enjoy the weekend. Thank you.
Great to be here.
Kevin Hassett, the National Economic Council Director. Thank you. Guys, I'll throw it back to you.
All right, and that was John Farrow speaking with White House economist Kevin Hassett. Really interesting last question there, too, from John, basically asking what is the one data point that Trump is watching? We've all been wondering what he's thinking about the stock market. We know that he's watching that. We've heard that this
He's not watching the stock market.
No, we heard from Bessent yesterday that it's one of the information pieces that he's looking at. We know that this administration is really focused on the job market, but bringing it back to this employment report that we got, that uptick in manufacturing employment, 10,000 jobs added. That was the note that Kevin Hassett left it on.
Right, I did think it was interesting of John to ask, is good economic data this administration's result? Is the bad economic data the Biden result? Knowing when that tone shifts is interesting, especially when there's so much uncertainty around March. Guys, I also thought it was interesting for him to double down to make sure, where do these tariffs start and stop? It's much broader than that. They want to level the playing field on everything, he said. This is an administration now singing from the same choir. And so that tariff uncertainty is set to last.
Singing from the same hymnal.
Oh, fine.
Right? The choir.
They're in the choir with one hymnal.
So, yeah, I thought his last answer was really the most fascinating as well. I mean, he gave 3 metrics that they're watching. Number of fentanyl deaths, which makes sense if this is a drug war. And then the number of jobs coming back to the U.S. He said he sees a massive amount of onshoring already, which is so fast. I'm surprised because I don't see it. And then he says, you know, in terms of revenue collected, they want to raise money with these tariffs.
Yeah.
So that's really fascinating. And again, I would love to see the clarity that Kevin Hassett sees. He says he's seen quite a bit of clarity already.
Did he say massive?
A massive amount of onshoring.
In some sense, there's quite a bit of clarity already. I don't know if traders agree with that because we've just seen such volatility in this market. The S&P 500 has posted back-to-back swings of more than 1% for 6 days straight. Taking a look at the size and scope there, that is the most since the November 2020 election, as you can see there. We'll see how today ends up, but futures are firmly negative as we count down to the opening bell. Obviously, there's the spin on this jobs report, the administration messaging there, but this market, not good enough.
And here's the problem. I think to Lori Calvasina this morning, speaking on surveillance, and the tariff posturing, it's just not hitting the market. This idea that will it eventually spur growth? There's still too many worries about inflation. At the same time, we have 3 rate cuts priced into the market. that puts up a stagflation worry, guys.
All right, coming up in less than 4 minutes, the opening bell. We'll discuss the market moves with Mary Anne Bartels of Sanctuary Wealth and talk to her about the Bitcoin reserve as well. This is Bloomberg. All right, we are seeing futures lower after a jobs report that missed the estimates, at least in terms of economists surveyed. We were looking for 160,000 in our survey here at Bloomberg. The Wall Street Journal was looking for 170,000 in terms of their survey, and the number came in at 151. So as a result, although you've seen some up and down, we are now down in terms of futures. S&P futures off 1/3%. Nasdaq futures down about 1/4%. You hear the opening bell on the New York Stock Exchange and on the Nasdaq. I believe it's a sea of ladies on both marketplaces because tomorrow is International Women's Day. It's interesting to see at the New York Stock Exchange. I worked down there when there were like 900 guys and 2 women. So they've really drastically changed that ratio. At the Nasdaq market site, normally, there are only people there to ring the bells. But in terms of the major indexes and the live cash trade, we have a lady for you to check on those as well. Katie, happy International Women's Day.
Happy International Women's Day to you too, Matt Miller. The market's not exactly celebrating right now. The S&P 500 down 0.3%. That pop we got after the numbers at 8:30, a distant memory right now. And remember 6,000 on the S&P 500? We're obviously getting lower and lower when it comes to these levels. Same story, too, if you take a look at the Nasdaq 100, down about 0.1%, even though we did get some relief when it comes to the chip makers. I'll get to that in just a moment. But you take a look at the small caps as well, really getting caught up in this sell-off on the Russell 2000. This is your worst performer year to date on the big index level. The Russell 2000 down another 0.2% today. Let's get specific here and look under the hood. We're keeping a close eye on the Magnificent 7 index following the jobs report, down about another 0.2%. But I wanted to take a look at Broadcom as well. You can see it's higher by about 3.6%. It reported earnings earlier, basically putting some life into that belief that AI spending, that boom, it remains strong. This gain, though, pre-market had been 8% at one point, Sonali. So even the enthusiasm over the specifics of Broadcom's report fading now in this market.
This is a market with low excitement levels. But over here, got another down era story. HPE down bigly. It says that profit in the coming year would be hurt by tariffs, weak margins, and on server sales. And the company is planning 3,000 job cuts. We've been talking about it. Kind of a brutal day over here, but more and more companies talking about that tariff threat, Matt.
All right, and we're also watching Gap pretty closely today. The turnaround playbook appears to be working as sales remain strong across most of its brand, up 7% at the main brand, the Gap, up 3% at Old Navy. Old Navy up 3%, which is, I believe, its biggest moneymaker in terms of revenue. And then Athleta down 2%, but Sonali's going to do something about that in this quarter. Let's turn back to the markets here because we are very close to correction territory on the Nasdaq 100 index. Right now looking at 20,032. And if we get to 19,958, that would be a 10% drop from the highs that we saw on February 19th. Bloomberg Technology Co.'s Caroline Hyde joins us now. So Caroline, we've seen already, a 9.5% drop, more than that, a substantial decline, and we're close to a correction. What are you hearing on your show, Bloomberg Technology?
Well, the hope was that Broadcom might steady some of that anxiety. And look, it is trading higher, and on a points perspective, it's the biggest contributor to the upside. But a lot of this may be down to short covering. That's why we saw some significant moves in the pre-market and indeed post-market yesterday after the bell. This is a company that was sold off more than $200 billion worth in terms of market capitalization only this year. And we were steadied in terms of seeing 19% growth in the fiscal quarter about to come. We're seeing significant, more than 70% growth in AI in particular. And this is where the anxiety dialed back a little bit. Are we just meant to be selling generative AI winners at the moment because we're not going to need as much compute because you've got all of these fantastical models coming out of China that seem to need less data and less compute to still give us incredibly powerful generative AI models? Broadcom managed to steady nerves, showing that hyperscaler demand is still there, showing that networking is necessary, and indeed that people still want to design their own chips. But it's not enough to dial back some of the anxieties more broadly as we head into a weekend where people don't want to be long tech.
That feels like the story of this market right now. It's just not enough. Of course, maybe that relief that we got on the jobs print, it wasn't good enough. What we heard from Broadcom, those stabilization of those fears, it's just not good enough. And I want to talk about how the trade picture fits into the big tech story. We had this conversation with Gina Martin Adams earlier in the week, and I just keep thinking about it, that you don't necessarily think of big tech when you're considering the impact of tariffs. You probably think of more physical goods that, yes, exactly, that we see and touch and feel. But she made the point that you think about the cost of goods sold for a lot of these big tech companies. A lot of that is outside the U.S.
Yeah, and that's why we want to be hearing from Antonio Neri on the show a little bit later. HPE, what are the cost of goods implications of tariffing China? What is it that we're going to hear from some of the big tech leaders who are going to Washington next week, among them IBM, among them Hewlett-Packard, HP? What are they going to say in terms of ultimately China exposure? For me, it's all about NVIDIA as well. Look, this is a company that is significantly impacted by potential tariffs and restrictions on selling into China in the future.
I am very much looking for your readout after that meeting on Monday, but I'm also looking for your readout from today because the White House is holding a major crypto summit. Bitcoin, while there was a lot of excitement about it, it's another asset that lost a lot of its bump since the election. But you have hundreds maybe of investors down in Washington now trying to get a readout. And you have David Sachs on AI and crypto.
He's the crypto and AI czar, and he's coming on the show before that 1:30 p.m. New York time meeting over at the White House, which, taking a step back, isn't that extraordinary that they're actually going to meet the president, these crypto executives among them? As you'll see, some of the CEOs of some of the largest exchanges going, turn around in the vibes around crypto. And the executive order front run it. We saw it yesterday saying, yes, you're getting your strategic reserve when it comes to Bitcoin. Yes, you're going to get a stockpile of other assets. But basically, maybe there were people out there thinking that they'd be able to buy more Bitcoin. That's not happening. They're not going to sell the Bitcoin that US government already holds, that they've taken from forfeitures. That takes away a lot of the anxiety that suddenly Silk Road confiscation is suddenly going to end up in the market, but not enough to perhaps support the run-up that we'd seen in Bitcoin and the hopes that had happened. But I can't wait to speak to David Sachs really about what he thinks is going to come from the crypto audit, what actually they hold, and then where next for an AI executive order. We need to know how they're going to keep on building US exceptionalism there.
That's a good point. He's crypto and AI czar, right?
Heady mix.
Yeah, big job there.
So many South Africans.
That's also a thing as well. Really looking forward to that interview with Caroline Hyde coming up at 11 a.m. on Bloomberg Technology, and it comes as Bitcoin below $90,000. I remember when we were at 110, but in any case,
dude, I remember when we were at 600.
Yeah, well, you know, you're.
And by the way,
you're one of the OGs.
That was many, many years ago, Matt.
That was, but on election day, we were still trading at below 70,000.
Fair enough.
So since the election, we're still up about 20 grand. On the Bitcoin
but can I tell you
price.
something? For a strategic reserve, I don't know how that benefits everyone who doesn't hold Bitcoin.
I have a lot of questions about the strategic reserve.
I
will leave it there. Let's get back to these equity markets because we are in sell-off mode. So let's get to Sanctuary Wealth Chief Investment Strategist Mary Anne Bartels joining us now on this jobs day. And Mary Anne, we usually look to you as sort of a bullish voice amid the noise. But you think about the concerns that we're dealing with right now when it comes to inflation, when it comes to growth, when it comes to the uncertainty over the trade picture and maybe the corporate America engine slowing just a bit here. What's your read on this situation?
So this is where I rely on the technicals. What are the technicals really saying about the market? And I would argue we are in a correction, even though we haven't quite hit that 10% level. I do think we're in a correction for the markets. And I don't have a signal that we've reached bottom yet. There's definitely a rotation happening. If you look at the S&P advanced decline line, it hasn't broken down, and that's one particular sign that's showing the rotation. You're seeing the profit taking in tech and tech related, and it's moving into healthcare and consumer staples. But I don't see those sectors as leadership. I still see tech as being the long-term structural leadership of the market, which makes me fairly confident that we're just in this correction as we have tariff tantrums. We're trying to figure out what Doge restructuring and the government actually means. So I expect that we can have some volatility within the market for not only the next few weeks, but maybe the next few months as well.
If you believe there's volatility, how much more downside is left? And the reason I ask that, Mary Anne, is I wonder if you're buying the dip here or if you think you have to wait to buy the dip. How do you play this?
So I always tell people trying to buy the dip, even traders don't get it right all the time. So it's kind of futile. I think you should have what your buy list is. You start dollar cost averaging into your buy list. But as for the downside, everyone's focused on the S&P 200-day moving average. We're pretty much there. You can undercut it and come back, but if we really do undercut it and we can't come back above the 200-day moving average, the next level of support is going to be 5,400. And then the level behind that is 5,200. I'm kind of in the camp that where we are, and I don't have a flush out in the market yet, the risk is that the 200-day moving average is not going to hold. What's really surprised me is that the put to call ratio has not spiked. So that's going to be one of the things that I'm looking for, is for a spike in that put to call ratio and maybe a climactic kind of up move in the VIX index. VIX is already elevated, but you probably need that to spike up a little bit more.
Well, I'm glad you brought up the 200-day moving average, and we have a great chart to show it.
It's beautiful.
It is beautiful. It's got a line on it, and it's got the S&P 500. It's coming up, but we were doing some really light, there it is, novice worth technical analysis yesterday. I know that you spent many, many years in technical analysis. So you mentioned that you think that the S&P 500 could break below the 200-day moving average. I tweeted this chart yesterday. I got a lot of questions to the effect of, do I buy the dip when we get below the 200-day moving average? I mean, if we do break below it, as you think we will, how big is that air pocket that it could create?
I don't think we're in a bear market. I think that's probably what we're all trying to wrestle with. Are we going into a bear market? I don't think we're going into a bear market. I just think this uncertainty has created a cloud over investors, and they're kind of frozen. And I can also understand if some business leaders are holding back on some business decisions until they have more clarity on where we stand on the tariffs. So the air pocket, I don't think is a bear market. I think it's a correction. I'm even a buyer here. I have been a buyer. Again, we're never going to know the exact bottom to buy necessarily, but I think between this level that we're at the 200-day moving average and around 5,400 in that range is going to be the really good buy zone, though, if I was really looking to time it.
All right, I just want to point out that we are looking at stocks that are edging higher here. We were lower at the open, and now the S&P 500 is putting up a gain of 0.1%, so not groundbreaking news. But look, I want to get to you on Bitcoin, Mary Anne, because not only, well, first of all, you own Bitcoin, we know, because we've asked you about it in the past. But typically, it hasn't been an asset with a lot of fundamental analysis potential. Now you've got, this sovereign crypto fund idea. What do you think that changes in terms of the path of the price? And also, what's your take on the technicals of Bitcoin?
So what I like about the Trump administration talking about creating a crypto reserve, I think that just gives more confidence and more credence to the asset class, that this is an asset class that's not going away. I think that's really important. Bitcoin has been correcting. In fact, most asset classes have been in a corrective phase. So I still think Bitcoin is in a correction, but is in a long-term uptrend. So the worst downside I can get is somewhere around 75,000. I think we got down as low as 78,000 on this pullback. So between 90 and 75, I think we're going to find a footing. And I'm still maintaining my target this year of 113 to 150 on Bitcoin.
Mary Anne Bartels of Sanctuary Wealth, we thank you so very much for joining us. Happy Friday to you. It has been a tough week in these markets. But coming up, we're going to look at the retail sector because the turnaround playbook at Gap is working. I hear people might be buying some Athleta next. I hear that that's the one part we're still looking at. We like our yoga pants here on this set. We're going to give you details on all that next. This is Bloomberg.
All right, it's time now for top calls from the analyst action in focus this morning. And first up, Bank of America getting upgraded to a buy over at Baird. The firm says that the risk reward in big banks improving. Next up, we have Steel Dynamics upgraded to a buy over at Morgan Stanley. The firm says that steel prices are up in reaction to U.S. tariff policy and sees higher cash flow at the company. And finally, let's close out with Macy's no longer a buy over at JP Morgan. The retailer downgraded after issuing a softer outlook for the first quarter. Matt Miller.
All right, we're going to continue to talk retail here because Gap is reporting strong quarterly sales led by its namesake brand. We call it a comeback. The retailer also saw better than expected results at its big Old Navy unit, and apparently Banana Republic still exists. Because
I love Banana Republic.
Yeah, get out of here.
Come on.
Well, they didn't exactly see growth, right? They just didn't see a
cashmeres.
decline. Let's talk about the specifics here on Gap and the week that was in the broader retail sector with Emily Cohn. She leads Bloomberg's consumer reporting team, and she joins us here on set. You're with me, right? Banana Republic, that's like a 90s thing. It's like Pearl Jam and flannel shirts.
So
Which are great
Gap.
things.
We were just talking about those Gap logo sweaters. Gap is having a moment.
I want one of those sweaters.
Well, talk to us a little bit about why we're seeing the 14% reaction. What exactly was so good that Gap stood apart from its peers in the retail sector?
So Gap is very much in the beginning stages of its turnaround. So they brought in its new CEO.
Oh, wait a second.
Emily, I think your mic fell off.
You know what? I'm going to fix that live here on set.
Yeah, while
Just
he
go ahead
fixes
and
that, Nudie and
I'll mic you
will
up
chat
Oh my God.
It's
a
interesting.
little bit about what's going
There you go.
on.
I'll put it behind
They
your
did
jacket.
mention,
Thank
of
you.
course, we
There you
had
go.
Banana Republic, Athleta underperforming, but overall it was a strong report from Gap.
So Gap in 2023 brought in a new CEO, Richard Dixon. He came from Mattel. He was at Mattel during the phase when Barbie became cool again. Barbie became a lot more inclusive. Barbie became a movie. And that was under the time Richard Dixon was helping to lead Mattel. So Richard Dixon comes to Gap in 2023 and starts a similar turnaround plan for the brand. And we're seeing signs that that turnaround plan is starting to stick. He brought in Zach Posen, other celebrity designers, to be its creative director. And I don't know if you talk to your Gen Z friends, Gap is very much cool
Or
again.
Sonali.
Well, you know, it's interesting. You know, you have the whole scale of things. You have kind of affordable fashion here, and then Zach Posen was one of the more prominent luxury designers in kind of New York high fashion too, wasn't he?
Yeah.
What still needs to be fixed though at Gap? Matt made this point to me. I buy a lot of Athleta. I think Katie buys
I do too. Come
a bunch
on.
of Athleta. And so, but that was one of the spaces that they actually didn't see the big rebound.
Yeah, I mean, athleisure is a very crowded, very competitive space. To me, thinking what it really is Athleta, like why would you go there as opposed to the other, you know,
Is it less expensive than Lululemon?
It is a little
Yeah.
bit less expensive, lower quality, I would say. But like I would say, like Old Navy is like I go to Old Navy for my kids. Like I can count on really good quality, cool, cute clothes, stuff that like they can wear a bunch of times and stain and not really like worry about
Right.
it. I see the appeal of all these brands, Gap, Old Navy, Athleta. I'm a little bit like, what's the cool factor there?
Right. Well, you take a look at Gap shares having a great day today, but still down about 5% year to date. Emily, great to get some time with you. Mic problems aside, that is
Sorry.
Emily Cohn of Bloomberg News.
Thank you for
Coming up,
having me.
last month's market turmoil really putting a dent in hedge funds returns, probably last week as well. We're going to explore all of that next in our Wall Street Beat. This is Bloomberg.
And it's time now for the Wall Street Beat. Today we're looking at the strategies endured by hedge funds in February, an absolutely brutal month for investors. Joining us now, Bloomberg's Justina Lee. You look at the numbers here, they were fascinating because very few people were up. Of the people who were up, it was not by much. And the reason I wanted to talk about it is because March is just as bad. So where you left off in February, you're continuing on. You've got to shift at this point. When I talked to Schoenfeld CEO, they were flat in February about why they thought they kind of held steady. They said it was their quant strategies. When you talk to investors, what seems to be working right now? Is everyone kind of looking for those hedges, even tail hedges at the moment?
I think what's funny is, obviously hedge funds love volatility. So in that sense, this should be a great environment. But we're kind of in this regime where it's volatility that you can't really predict and you can't really put in a systematic model. But at the end of the day, that means there's more dispersion across names. And, if you're a macro trader, there are kind of bigger moves, from bonds to stocks. And so once you kind of get used to this environment, it could be actually a pretty fruitful environment. And I think, if you think about kind of more dispersion, I mean, that should be good for a lot of quant strategies.
Well, let's talk specifically about risk parity. Of course, Bridgewater out the gates with their all-weather ETF yesterday, their first time in the ETF wrapper. And what a moment to launch a strategy like that, because after some kind of not so great years, you can see that risk parity actually outperforming the 60-40 and the S&P 500 so far this year.
Yeah, I mean, the simplistic way to look at risk parity, which they hate, is that it is relatively overweight bonds. Because what they do is they want to put more money in bonds and then kind of leverage that up. And so the problem with risk parity over the past decade is you really could just buy the S&P 500 rather than hold any treasuries. But in this environment where treasuries are hedging the S&P 500 very often again, that's been kind of a good environment for risk parity, and it's kind of an interesting turnaround.
All right. Very interesting stuff. We're very focused on risk parity on this team.
Yeah, we spent several minutes on it in our morning meeting, but it's an interesting point. That
a couple days in a row now because of All W, right?
Yeah, All W. That is the Bridgewater fund launched in partnership with State Street. But Justina makes an interesting point about, you think about what is hedging right now. Treasuries have been working on and off, but the correlations really between the different asset classes have been kind of all over the place.
It's lucky, too. If you're using bonds as a strategy here and you're leveraging it, the cost of leverage, the silver lining is that it's cheaper because of that move down in the 10-year, even the 2-year, and the potential for rate
leveraging
cuts.
Bonds right now sounds like a dangerous game.
Especially if you're leveraging 50 to 100 times that basis trade.
All right, we're going to continue to focus in on the basis trade because it's so important to our clients. Coming up in the next hour, PIMCO's Tiffany Wilding joins us. Then we have a conversation with Brown Harris Stevens CEO Bess Freedman on real estate. I'm very much looking forward to that. And Lumen CEO Kate Johnson joins us after a volatile few months for her stock. Stick around. This is Bloomberg. We are 30 minutes into the trading day on this Friday. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, payrolls, missed estimates, but not as much as feared. PIMCO's Tiffany Wilding is going to react to the data.
Then we're going to focus in on Fed Chair Powell. He takes the mic as President Trump's policies inject a little bit of chaos into the economy and the markets.
A little bit of chaos there. We'll also talk about Broadcom's results, suggesting that the boom in AI spending is still strong. The CEO of Lumen Technologies will weigh in just a bit. But let's get to these markets right now. A little bit of a turnaround underway on the S&P 500 on pretty hefty volume. You can see we're back to unchanged. We had big pre-market gains, big being relatively speaking. Then we were down about 0.2%. Now we're back to unchanged, really sitting on the knife's edge here of the 200-day moving average for the S&P 500. We'll watch that, as well as the Nasdaq 100 with big tech really in focus here, currently higher by about 0.1%. Then you take a look at the bond market. That sell-off easing just a little bit. You can see now that yields are lower by 3 or 4 basis points or so on, I think they're higher though. In any case, you can see that the 10-year yield. Yeah, I think we were at 421 earlier, but
we were when the show kicked off.
Yeah.
Nonetheless, that arrow is pointing down.
It certainly is.
And the color is green, which means investors are buying bonds.
We're going to look into that, but the point that you need to know is that your 10-year benchmark treasury yield is at 4.24%, Matt Miller.
All right, a little bit of confusion this morning. We heard from, on that note, White House National Economic Council Director Kevin Hassett last hour. He shared this outlook.
There are lots and lots of different things that we care a heck of a lot about. For the drug war, the thing we care about is reduction in deaths of fentanyl. In the economy, what we want to do is see a creation of manufacturing jobs, especially auto jobs. And we want to see a successful tax bill. And I think that all of that is going to give us the 3 or 4% growth that we're all hoping for.
Joining us now is Tiffany Wilding, PIMCO economist, and Tiffany, you know, he's talking about the things that they're watching, which I thought was interesting and legit. The confusion comes from a couple of other statements he made to John Farrow in that interview. He sees a massive amount of onshoring already. I wonder if you see that as well. And he said he sees quite a bit of clarity in Trump policies. Is that fair?
Well, you know, I think the overall what we would say is the Trump administration is trying to implement what are pretty big policy pivots. We see the focus here is reducing the trade deficit, reducing the fiscal deficit, and reversing what economists call labor share, the hollowing out of the middle class that's happened over several decades. These things are structural shifts, and trying to reverse them, you know, over a short time or a cyclical horizon, you know, is just going to be tough. And it's going to face political, economic, market constraints, you know, and it could potentially result in some disruption. So, you know, I think it is clear what they're trying to do, you know, but whether they can do that, you know, amid the constraints that we have in the U.S. economy, they have small margins in Congress, by the way, you know, and other constraints in other economies. I think implementation is what is more uncertain and going to be difficult.
Well, also, if you think about what's still uncertain, too, there are the Doge-related job cuts and other weaknesses in the economy that are still obviously not seen in the report that we saw today. How do you map out what to expect next?
Yeah, no, and I think that's a really great point, which is that even if some of these, I guess, Doge-related moves are not codified in law to actually reduce government spending and to affect the deficit, you know, they are going to affect economic outcomes in the near term. We have seen, you know, what surveys are starting to estimate is 50 to 60,000 people, you know, that have lost their jobs across federal government and contract workers. You know, that should show up in the labor market surveys. And so, you know, I think we're setting up here for potentially, you know, more of that disruption to be seen in the March survey. You know, and if you take a step back, you know, one of the things that we think has really driven labor markets or has helped labor markets, maintain very strong momentum over the last couple of years has been immigration. You know, the massive immigration flows that we've seen. So as that, stops, that should also really reduce labor market momentum. And so I think we could start to see that over the course of this year, you know, whether that really creates, recessionary views of recessionary risks, you know, that then compound. We're already starting to see sentiment drop, I think is the key question. And that'll be the key question for the Fed. Outside of the inflation risks.
Well, tying those two things together, I mean, we also heard from Kevin Hassett speaking to reporters just a few moments ago, saying that we will see a bigger hit on government employment in the next few reports. So if we see big weakness there, we know what the administration will point to, but jobs are still jobs, still has an impact on the labor market. So I want to hear more directly your thoughts on how the Fed handles this, because if the labor market is weakening, they have to respond.
Yeah, well, so I think like one thing that's a little bit of a complicating factor is that federal government employment has actually been, you know, more or less flat over the course of the last several number of years. The increase in employment has really come from contract workers, and there is a lot less data around actually how many contract workers or folks have been employed as a result of these government contracts. There's various ways to estimate this. You know, we think that's the potential for a bigger impact here. That will not be categorized under, the federal government workers within the employment report. So it'll look like more economic weakness potentially. It'll be difficult to understand, you know, what is related to those contract worker separations versus just what is broader economic weakness. You know, and I should say on that, you know, we are seeing sentiment deteriorate. You know, the equity market is a very important sentiment indicator. CEOs obviously look at their stock price when they're thinking about investment and hiring decisions. And I think the real risk here is that you have, sentiment that deteriorates that results in a more meaningful for slowing. And I think the Fed would definitely be very attuned to that.
What do you think about, the goal of this administration, as we hear from Scott Bessent, is to lower yields on the long end. And at least so far, they've done quite well, regardless of why we see that. And then, obviously, they want the Fed to be cutting rates. Now we expect more Fed rate cuts as well. So what are your expectations for the Fed through the year end and for the 10-year as well?
Yeah, well, I think ultimately the Fed, I think overall these policies present a very tricky environment, for the Fed and for central banks because, although on the one hand, they will contribute to slower growth, slower labor market momentum. I think they potentially increase downside risks, at least in the near term. But on the other hand, it's not necessarily obvious that inflation is really going to be dampened by that, right? You have potential one-off adjustments related to tariffs that will, that will support inflation, and then some of the slowing in immigration, because immigration impacts both supply and demand, not as obvious that will have a meaningful, kind of dampening effect on inflation either. So the Fed will have to manage that. Ultimately, I think if downside risks to the economy are greater than what the Fed perceives as upside risk to inflation expectations, they will react. And I think the near-term risk, at least, is that you do get more cuts being priced in, for the Fed, even if later this year the focus turns to, tax cuts, the potential, the things to deregulate, within the finance industry and what have you. I think near term, the focus is more on the potential for some economic disruption.
Tiffany, we thank you for joining us this morning. Tiffany Wilding of PIMCO, and of course, a very complicated jobs market. A lot of concerns still out there about inflation, but first, some of those are hitting stocks right now, actually. Costco is among retailers that's now taking a cautious outlook as U.S. consumer confidence declines. The dip in Costco, guys, it's interesting. It's actually the biggest drop we've seen since March of last year, and we know that they're certainly not the only one feeling this kind of a pain.
Yeah, and it's interesting. I mean, I guess it theoretically is a retailer, but it's a different type of retailer than a Gap, for example, which is having a great day. But broad brushstrokes, the retail sector has been in an interesting place. Let's also talk about Intuitive Machines.
I just want to point out,
yeah.
You're right in that it's a different kind of retailer. They missed earnings expectations, but BJ's, which is a big competitor to Costco, really knocked it out of the park.
So there you have it.
So BJ's had a huge surge in its stock as it did well on revenue and earnings. But the interesting thing to me is among all these retailers, you're seeing these notes that they're exposed to Chinese imports and asking these importers to cut prices because they're worried about tariffs.
Yeah, specifically that was a story about Walmart yesterday. That was a big theme, but there's a lot of nuances here, a lot of idiosyncratic stories when it comes to all these earnings reports, so have to read really closely here. Let's talk about Intuitive Machines. I had to look up what this company is, but apparently it just got in touch with its moon lander, which touched down 250 meters from its intended target. I believe that precision is the name of the game when you're sending things to space. So as you might expect, the shares are down over 20%.
Especially here, because I was listening to this landing live on Balance of Power radio yesterday.
Wow, do you listen to that a lot?
I listen to it every day, as you know. And it's just interesting to hear a moon landing. It's like a sports event, but there were so many different voices. I got a ton of data from that show. So Joe and the team did a fantastic job. The problem with missing the mark with this lander is that they need to recharge in order for the machines to work and to get the data and to send it back to Earth. But because of where they landed, they can't recharge the satellite.
You know what else has been sort of kind of a little bit going to the moon?
Oh, no.
Oh, no.
Is that what you're doing?
Is that bad? Is that a bad pivot? Walgreens, because it's planning to go private in a deal with Sycamore. It's up 7%. It might not feel like a lot. It's a stock that's up 22% this year. It's had years of declines. This has just been a stunning story. Finally, the announcement this morning, this has been kind of out there in drips and drabs. We broke this just days ago. They will be purchased for $10 billion. And remember, the reason that this is an interesting ongoing story is there's going to be a lot of really fascinating financing deals around this too. So it is a story that has Wall Street on high alert.
Well, just quickly, Sycamore, the details of this, they will pay $11.45 a share in cash for Walgreens. You take a look at where the shares are trading right now, just about at $11.40. Not much of a premium, of course. They were about 8% below yesterday when this deal was announced. So we'll see. But you take a look at that 5-year chart. It has been an ugly, rocky 5 years for Walgreens, and now it'll be a private company, theoretically, if this deal does close in the fourth quarter.
You know, it's just one company where private equity is taking the lead. Private credit is actually funding the $4.5 billion debt packaging, and the reason that's interesting is because bond market volatility kind of sucks right now. It has been elevated at the highest levels of the year, and so public debt markets, it's tough right now. So yes, going private, that's the move for the moment.
All right, if you are looking to refinance your mortgage.
Yeah, more about bonds, but
or
not
if
for
you're
consumers.
looking to get a mortgage at a lower rate. There's good news in these markets. Those rates continue to fall. We're going to get a read on the real estate industry with Bess Freedman, Brown Harris Stevens CEO, next. This is Bloomberg. Let's get now to high interest and look at what's making headlines around the world. President Trump says he is strongly considering large-scale banking sanctions and tariffs on Russia until a ceasefire and final peace agreement is reached. In a post on Truth Social, the president wrote, "To Russia and Ukraine, get to the table right now before it is too late." And he added, "Thank you," which was very polite. Nasdaq is planning to offer 24-hour trading on its exchange. It's the latest venue trying to capitalize on growing demand for U.S. stocks. It plans to enable the extended trading 5 days a week and expects to start round-the-clock trading in the second half of next year, pending regulatory approval. It follows moves by the NYSE, which filed its own application to offer extended trading earlier. And SpaceX's mammoth Starship spun wildly out of control and broke apart during its 8th test flight. It's another setback for Elon Musk's company less than 2 months after its last mission exploded. The rocket sent debris shooting through the sky. SpaceX lost communication with it about 9 minutes after the launch. Musk said the next ship will be ready in 4 to 6 weeks, calling the incident a minor setback. Sonali?
And Matt, we've been watching this really closely because we talk about that bond market, but for the 7th straight week now, you've seen that decline in the 10-year, and even more so for consumers, the mortgage rate has fallen. The average rate for the 30-year loans was down to 6.63%. Still feels high, but it does prove some relief for house hunters that have been sitting with that 7% mark roughly. Let's get a read now on the housing market with Bess Freedman, Brown Harris Stevens CEO. Brown Harris Stevens is a luxury real estate brokerage based in the New York metro area and South Florida. You know, on one hand, nice to see mortgage rates declining. On the other hand, we're seeing weakening economic data. If you're feeling broke right now, then why you wouldn't go out and buy a house, even if you see rates declining, would you?
No, and I think that's a great point, that people are feeling stressed. Prices are still very high, and even though rates have ticked down a little bit, people are still not able to afford homes. And the inventory is still very tight in certain areas. So I think, yes, this is a little bit of a positive step, but you still have that lock-in effect where sellers don't want to list and sell their homes because they have a 2 and 3%, and that still remains a challenge for our housing market.
So what is the level that we need to get to roughly where things start to unlock a little bit? 2 to 3%, that would be great. It feels like we're a long way away from there specifically, but where could this...
I would refinance at 2%. That's insane.
I think we don't see it again.
That's what I'm saying. I would love to see 2%. I don't know if we will anytime soon, but where do things start to move a little bit?
I mean, studies have shown that around 5% more people will get into the market. Sellers will be more inclined to list and sell. So I think that would help. But the more we start to move down, the better the market will move. We'll have more fluidness. But right now, you know, the housing market has been very confusing. Even though January was a good month overall, it's slow and steady. And the chaos or the turbulence that we see in the overall economy with tariffs and all the things that we read about creates strain and uncertainty, which is not good for any market. So, you know, we're waiting and seeing what happens.
Bess, what I'm not sure if I'm right in this, but I always think of you as doing high end. Maybe that's just because of you. But what do you see in terms of the different markets, right? I mean, lower price stuff, I imagine, is still difficult, but are you having trouble selling $5, $10, $15 million properties?
You know, it's interesting. We do everything, including rentals of studios. We do it all, but the high end has been very good. We've done a lot of business. Remember that the bonuses on Wall Street were 20% higher. People have a lot of money, so the high end is doing well. The challenge overall in the national housing market is really that people can't afford their first-time homes. That's, the first-time buyer is the one that's challenged today more than ever. And so I think we're going to need to see more inventory movement in rates before we see improvement there. But this is a discretionary market. Let's be clear. New York City is a discretionary market. If you own in New York, it's a choice. If you own in Palm Beach, it's a choice. Most Americans don't have that choice.
What do you see as fallout from, and I know you're not in the Carolinas necessarily heavily or in Los Angeles, but those two disasters have displaced so many people. Do you see fallout in New York or Florida?
I think that people are making decisions. Some people are deciding that maybe it doesn't make sense with the price of insurance and to rebuild and do all the things. There's ecological issues that people understand when they move to places like that, and some people will make moves based on that, but some people will say, you know what, I know what the risks are, I'm going to stay here, I'm committed to it because of the community and what it offers. So yes, I think you're going to see some movement, just like with COVID, which served as a catalyst for people to look at other places.
Well, one of those places, of course, was Florida, specifically South Florida, a market you're involved in as well. Was that just a COVID trend? I mean, you hear mixed reports that maybe that Florida boom is starting to slow a little bit. I mean, things are expensive in Florida. What are you seeing there specifically?
I mean, it's unfortunate, but we're still seeing some migration of New Yorkers moving to Florida. And I think because of taxes and other things, people are going to continue to do so. So I think that's a challenge that New York has to reckon with, and we have to create places, more homes for people here, make it more affordable.
What's the Trump effect? I was down there a couple weeks ago. I'll be down there next week again. I think even the week after too. It's a lot of Florida time for me. A lot of interviews down there. A lot of people are headed down there.
A lot of conferences.
A lot of conferences. A lot of businesses have moved to Palm Beach, for example.
But how much does the president's activity there draw more people down there? I'm hearing tech executives starting to move, people coming out of San Francisco now. Are you seeing that?
I think so. I think, look, people want to be close to power. I mean, it's a human thing. People do want to be close, and they're drawn to that, and it creates a lot of attention, and restaurants are full and people are there. I mean, there's a lot of New Yorkers in Palm Beach, and the people that have lived there forever, for generations, are a little frustrated with now all of a sudden they hear cars are honking their horns. It's a little bit more New Yorkers bring a lot of noise with them, so we know this. It's good noise, but sometimes people just want quiet. They want to play tennis, they want to swim, golf, they don't want all the chaos.
That's why they have Naples. All right, Bess, great having you,
Thank you guys.
On the program. Thank you so much for joining us. Hope we can talk to you again soon. Bess Freedman there of Brown Harris Stevens. Coming up, would you rather live in Dallas or in Salt Lake City? That's a question some Goldman managers have to answer because they can't stay here. We'll have details on that story next. This is Bloomberg.
Now, Goldman is giving managers a choice: move to Dallas or Salt Lake City and leave New York behind. The push to locations outside the main hubs aims to drive down costs and tap a pipeline of talent emerging in those regions. The bank's Dallas hub has already grown into one of the largest operations in the world. Now, some managers are getting this choice: move or leave, right? And the name of the project, guys, I think is fascinating. Project Voyage. So there is a longer effort, a bigger effort, not just here, but also in London as well. Some people like the move to Dallas. Do people like the move to Salt Lake City as much? I don't know.
Absolutely. I would absolutely go to Salt Lake City. We were talking about it early.
Yes.
You get cowboy hats and big trucks if you move to Dallas. You also get that if you move to Utah. So that's where
Is there a Kino Sabe in Salt Lake City?
We should open
There probably is, and probably in Park City. You're so close to the best skiing really in the country
Fantastic.
that I would go there. The funny thing to me is, the ironic thing is that when I was a kid, if you worked at Goldman Sachs and had to go to Dallas, that was like going to Siberia. That was literal punishment.
Equities in Dallas.
Yes, exactly, from
now,
Liar's Poker.
Yeah, now you have a lot of exchanges also moving to Dallas. The Dallas or the Texas Stock Exchange would like to open as well. Really quickly, we do have some breaking news, and that is that Donald Trump is now scheduled to deliver marks at 11 a.m. Eastern. That is according to an email statement from the White House. So stay tuned. This is Bloomberg. All right, let's get a check on these markets. We've been wiggling around a lot, and at least for right now, the S&P 500 a hair lower, down about 0.1%. We've been up, we've been down in the wake of that non-farm payrolls print that we got at 8:30 this morning. A slight disappointment there, but maybe not so bad that we're seeing just another day of sell-off because, boy, it has been a brutal week. The Nasdaq 100 down a little bit more. The 10-year Treasury yield camped out at 4.25%. But let's focus in on some single stocks and the tech sector and AI broadly because AI, when it comes to Broadcom extending gains after the chip supplier's earnings reassured investors that AI spending remains on track. You can see shares up almost 3%. We were certainly higher than that pre-market. But another AI name we're keeping an eye on right now is Lumen Technologies. And I'm pleased to say that we're joined by Kate Johnson. She is the company's CEO and president. It's great to speak with you again, Kate. The last time we spoke in late October, you had just signed a deal with Amazon to basically build links between Amazon Web Services' main data centers and smaller outposts near big cities. You have similar deals with the likes of Meta and Microsoft as well. As I understand it, these are long-term leases that is happening here. So when will we start to see that leasing revenue on these new routes start to show up in your earnings?
Yeah, it's a great question. We're in kind of the early phases of the evolution of the AI marketplace. Phase one being hyperscalers, cloud companies, big tech thinking, okay, how are we going to serve up and train these AI models? And they're connecting their data centers. We've won a lot of that business. We're excited. We hope to win a lot more. And I think the next phase is when enterprises start to use those models. So from the perspective of us building out the backbone of the AI economy, it's a couple of years before the revenue actually starts to come in at steady state. But as we see, the enterprises are asking to upgrade their networks as well. Going from 1 and 10 gig to 100 and 400 gig, it's a race for bandwidth, and Lumen's got it. So we have a couple of different phases that we're enjoying.
I just want to point out, completely separate from this conversation, we are seeing a drop in the Nasdaq 100 right now, trading at 19,950. Does that leave us in correction territory?
I believe we're officially there.
So that's a bigger than 10% drop from the highs on February 19th. Not terribly important, just a big round 10% drop number that I thought I would share with viewers. Now I want to get back to the Lumen conversation. You've seen a lot of volatility in your stock as well, Kate. We were looking at a long-term chart, and you just absolutely crushed it in 2024. I think tripling the value of your company. It's been a drop in 2025 since those highs as well. Does that change the way you do business? I mean, do you look at the stock over, months or years, and do you need that currency to do your business, or was that, a capital raise when you sold the shares and now you're just barreling forward with what you do?
Hey, look, we're super proud of the progress that we've made with respect to the stock price. 200% growth year over year today is something to be proud of. But that's not what we think about. We're obsessed with what our customers need, and we're delivering it day after day, and we're designing the future of networking, and that's how we're ingratiating ourselves to them. That will accrue to shareholders, that will accrue to employees, but it's all about customers. That's our mindset every single day.
Speaking of customers, if you look at what is kind of going on in the broader atmosphere here in recent weeks, there has been, let's say, a relatively negative tone around future spending plans, about future prospects. You really see it in the Philadelphia Semiconductor Index more than anywhere else, perhaps. How do you look at what's happening amid kind of the turn in attitude with investors when it comes to the hyperscalers and even the chip companies, given the broader environment right now?
Look, I think it's early days, and I think all of these companies are figuring out their strategy and their architectures for how they can thrive. And we think about it at the aggregate level. So there'll be puts and takes with every one of these players. We don't get wrapped around any one of those outcomes. We think about it at the aggregate level. And we are seeing a once in a generation spike in demand for fiber networking services. It's a race for bandwidth, and Lumen's got it.
And of course, we've seen that in the deals that you've signed with some of these power players. I want to talk about, again, the specifics, the fundamentals of your business. And this gets back to my question on leasing revenue, because you take a look at your revenue growth, it's a little bit under pressure. Margins have been under pressure a little bit as well. When would you expect to return to growth when it comes to revenue, when it comes to margins expanding again?
So we've always talked about 3 phases to our recovery and turning this company around. And the first thing you need to think about is we are not looking for growth in the legacy world of telco. That's not, we're building the future for companies to thrive in a multi-cloud AI world. The first thing with the $8.5 billion of PCF deals that we did last year, we are now stable from a free cash flow perspective, and it's funding our transformation and giving us cash to pay down debt. We paid down $1.6 billion last year. We have more plans for tweaking the balance sheet on the horizon. We called on the last earnings call a pivot to EBITDA growth late 25, early 26. We're super excited about that progress as well. And then the third leg of the stool is revenue. And we have 2 growth levers that we're leaning into heavily. The first we talked about, building the backbone for the AI economy. That's going extremely well. We have a big head start. We're building the competitive moat every single day. A big part of that competitive moat is the digital platform we're building on top of it, our physical infrastructure, to make it easy for enterprises to consume networking services. It's differentiated. It gives them control over performance and bandwidth and security. It gives them a consumption model. And it gives Lumen shareholders digital revenue, which, as we know, is highly valuable. And both of those growth lever trajectories are going extremely well.
I just want to seize on your once-in-a-generation quote, Kate. I'm 51. I started working here in 1999. So I've seen a spike in demand for fiber twice, like this, around the internet bubble. At that time, companies were working on boosting revenue and weren't really bringing in a lot of free cash flow, weren't earning a profit. What do you see in terms of free cash flow and profit expectations at Lumen?
Look, we think about this fiber network asset, by the way, world-class, great coverage, unique routes, and we're winning business to build the backbone. And we think about it from 2 perspectives. One is capacity. We have a great partnership with Corning. It gives us 4 times capacity on existing routes. We're leaning into photonics innovation for greater fiber efficiency, and we're building new routes funded by customers. That's different than the old days where it was kind of, if you build it, they will come. We are doing this in partnership with customers. The second piece of it is driving utilization. The $8.5 billion of deals that we did with tech companies was leveraging once empty conduit. So we're doing something extraordinary right now. We're dramatically improving the capacity of our network, essentially expanding the internet at large. And we're materially improving utilization, which gets a return on these assets for shareholders that frankly is long overdue. We're super excited by the progress, and the future is very bright.
But net income, when are we going to see a positive number there?
So as you saw last quarter, we had great numbers and results, and I think we're thinking about it from the perspective of free cash flow done, EBITDA turnaround on the horizon, revenue after that. Stick with me.
Got it. Kate, thanks so much for joining us. Kate Johnson there of Lumen talking us through her business. And obviously, we've seen just incredible growth in that stock over the last year. It's been a rough beginning of the year for tech stocks broadly. And for the Nasdaq, we're now seeing a correction.
It's interesting. You take a look at what is dragging the Nasdaq 100 to correction territory right now. The biggest loser in the Nasdaq 100 is Costco, down about 6.7%. A good reminder that the Nasdaq 100, you do have to look under the hood. It's not all tech, but we know that the Magnificent Seven in particular has been under pressure as well. We reached correction territory on that grouping a week or 2 ago, and now you have the broader index following as well.
Right, it's interesting because to your point, it's not just the big tech names in that Nasdaq 100, but the tech names that are down, you're seeing it continue to have a bunch of pain. Marvell is that second biggest loser. We know that they had a tough earnings report earlier this week in terms of how it was received by investors. Lululemon is another big decliner in the index too, to your broader point. I'm also watching Netflix because I saw somebody make the point the other day that if you're worried about tariffs, if you're worried about economic growth, how sticky is Netflix's stock? I thought that was an interesting question because do you stop buying subscriptions to broader media companies if you are a little burned on the consumer side?
I mean, you have Netflix already. Everyone's bought.
Everyone's already bought it.
And you're not going to cancel it. But the quality, do you think the quality of their programming is just getting worse and worse?
No. Are you seeing?
Have you seen Zero Day?
I have not seen Zero Day. I don't know if those are the existential questions hanging over the market as a whole
Game?
right now. No,
The new
Squid
Kate
Game,
Hudson
I couldn't
show.
do it.
So
In any case, the story might turn around because coming up later this afternoon, we have Fed Chair Jay Powell. He's going to give his view on the U.S. economy. We'll bring it to you live at 12:30 p.m. Eastern. But before that, we're actually going to hear from Donald Trump, now scheduled to speak at 11 a.m. We don't have any specifics on his comments, but this
we're going to tune in anyway.
We're going to tune in. This coming in the last couple of minutes. Stay tuned. All right, it's time now for our Wall Street Week conversation, and women's professional sports are growing quickly, with the WNBA's attendance almost doubling last year alone. David Weston spoke with Golden State Valkyries president Jess Smith about the investment in women's sports.
Since Caitlin Clark emerged as a budding superstar at the University of Iowa, women's basketball has skyrocketed, garnering the league more fans and opening up new markets.
We are the first expansion team since 2008. The last was Atlanta. And then following us, we have Portland and Toronto next year. So growth of WNBA has been a long time coming. And it's taken many years to get here. This building has actually always been here for the Golden State Warriors, and now it's our Valkyries Performance Center. So this is the area that, you know, the championships were won before Chase Center was built.
As in Steph Curry?
As in Steph Curry, yeah, small name, right? And now we've had an opportunity to make it our own.
Jess Smith was the head of revenue for the NWSL's Angel City Football Club, where she introduced new sponsorship models and broke records in attendance. She is now the president of the WNBA's Golden State Valkyries, the first expansion team in 17 years.
When you look back during COVID, the WNBA actually got together and played. They were the first league to do this. It was also a really key moment to where consumers were sitting at home on their couch, looking for entertainment and tuning in, and really taking note of these incredible athletes, really taking note of what they were standing for when it came to social justice. And there was an unlock that began to happen with consumers in women's sports. So as consumers began to unlock giving those ratings, began to unlock buying merchandise, buying tickets, and understanding that their dollars in time and interest was driving the growth of the W, media listened, right? Teams listened, leagues listened, and more investment began to come in. And those consumers have really, really rewarded everyone in that circle that is equated to the growth.
When we talk about growth, how do you measure it? What are the metrics you pay attention to?
There's two things. One is money and revenue, right? Are your revenue lines growing? Are you investing in the right way to make sure that those are growing exponentially? And two is fandom. How many people are coming into your ecosystem through purchases, but also followership on social media or TV ratings? And so if you're looking at both of those, the growth is very significant, but we have a close eye on both every single day.
As fast as women's professional sports are growing, they still lag behind their male counterparts, at least for the most part. Where the NBA playoffs averaged 4.5 million TV viewers last year, the WNBA had 1.1 million. 22.5 million fans attended NBA games in person, where the WNBA had 2.4 million. But the gap is closing. Viewership numbers were up 139% for the women last year, but down 12% for the men.
You have a foundation in both men's and women's sports. From your experience, what's different about the two?
That's a really good question. I don't know if I've been asked it that way before. I would say the assumptions of things. In women's sports, it's been assumed that when you create a product, well, you better not lose any money.
And that was David Weston speaking with Jess Smith. You can catch Wall Street Week tonight at 6 p.m. Eastern. But coming up on this program, we'll get back to these markets. The Nasdaq 100 falling officially into correction territory, down about 0.6%. The S&P 500 not too far behind, down about 7% or so from its peak, currently down about 0.5% on the day. And then you take a look at the bond market, maybe finding some safety in the long end of the Treasury curve with yields down about 3 basis points. Much more coming up. This is Bloomberg. In today's ETF Friday, we're taking a deep dive into how First Trust, it's a quiet financial services company, it lured billions to its ETF empire with some creative sales tactics. Emily Grufeo spent a long time reporting out the story. I am thrilled to say that she joins us now. So Emily, over at the ETF desk on the Bloomberg News side of the building, we often talk about how ETFs are sold. They're not bought. And First Trust certainly was selling its ETFs.
Yeah, that's right. I mean, they were kind of known in the industry for their selling of the ETFs. They connect with financial advisors instead of marketing directly to retail. What our reporting shows, though, is that using internal emails that we uncovered through this process, I worked on the story with Max Abelson, there were some instances where First Trust has pushed up against industry lines when it comes to how you can actually sell these ETFs, and in some cases arguably crossed the lines. FINRA essentially says, you can't promise something in exchange for a sale. You can't say, you do this, I'll take you on this vacation if you do this sale with me, for example. And you also can't have dining and entertainment that is too frequent or extensive enough to raise any question of propriety. So that's a little bit of a gray area. Like, what exactly is too frequent? What exactly is too extensive?
Right. So the story kicks off with a line that really hit home for me from this guy, this salesman, Jim Bowen.
This hit home for me, too. It was a great quote.
So he's talking about financial advisors, the nobility of what they do, and saying, they spend their entire life tending to the wealth of others. And that's how I think of my financial advisor. I'm like, man, this guy is doing me a real solid.
Yeah.
But then I realized he is also always trying to sell me, a slate of products that he has. This is what they do, right? This is not specific to First Trust. It's just how the industry works.
Right. But what we do know, and what is different about First Trust, is that when you look at the data and the estimated revenues, First Trust makes almost as much revenue, at least according to BI estimates, as Vanguard, but they're about 15 times smaller. So that anomaly, we know, makes First Trust stand out. And FINRA is looking into First Trust's sales practices. So that investigation is still ongoing. So we don't know how it will end. But as far as I know, there's not other major ETF companies where FINRA is investigating.
And you have some great quotes in here. Again, a deeply reported piece. It's just a joy to read. One of these quotes is from a wholesaler who worked with First Trust from 2011 to 2020. And he said to you, you're selling the most expensive ETF with mediocre performance. You better do something different. And that's what we did. So you mentioned that we're talking about a company that's much smaller than Vanguard. But when you take a look at their lineup, I mean, what kind of products are they actually selling? And what kind of costs are we talking here?
So they have a lineup of buffer ETFs, which is kind of a space that they really dominate in.
Magical ETFs.
Exactly. Those are more expensive, but you would expect those to be more expensive. But they're still relatively more expensive than the other buffer ETFs. But some of their biggest ETFs are index funds. There's a dividend index fund. Now, it is an enhanced index, but it's about 60 basis points. So every category of funds that they had, our reporting showed that every single fund was more expensive than the competitors' funds.
To Matt's point, on one hand, there were some very specific examples of here, and I'd love for you to kind of name some of them, because part of this is activity in the industry that we see other places that, to your point, toes the line between the relationship between these companies and the FAs that then meet the clients. What was First Trust doing that was particularly extravagant, let's say?
I definitely don't want to spoil the whole story. I want everyone to go out and read it. But in terms of specific examples, we uncovered one internal email where a managing director was telling his employees essentially, we have wholesalers repeatedly saying, if you do this business, I'll get you on this trip to Chicago. They were known for sales forums where they would take the advisors out and they would pay for the flights and the hotels to go and sell these ETFs. So read the story, you'll see these specific examples of crossing the line.
Great reporting by Emily Griffeo. Go check out that story. In the meantime, we do want to bring you some breaking news, and that is that Putin is said to be ready to agree to a Ukraine truce with conditions. This news just coming in the last couple of minutes, of course, suggesting that maybe there's some progress towards a final peace settlement, but working through the details right now. But that headline, once again, Putin said to be ready to agree to a Ukraine truce with conditions.
Some more details here. This would be a temporary truce, provided progress towards a final peace settlement, which could lead to a lot of headlines over the weekend. This is, of course, a Friday, and these weekends have been very volatile.
Right. I mean, we should point out that our reporting shows that this first positive sign from Vladimir Putin was conveyed at last month's talks in Saudi Arabia between top Russian and American officials. We were reporting on those. So this isn't new news from...
Right.
In terms of, it's not like Putin said this morning, okay, I'm ready.
What is new is that the U.S. and Ukraine do plan to meet in Saudi Arabia next week for direct talks. And so this, to your point, not so new news around potential ceasefire.
Well, it's interesting to see that because we're 1 week out from that extremely tense Oval Office fight, if you want to go that far, between J.D. Vance, Donald Trump, and the Ukrainian president as well. Now, like you mentioned, Sonali, we do have new details that there is a plan for the U.S. and Ukraine to meet in Saudi Arabia. And of course, this comes minutes before the president is scheduled to speak. We don't have details exactly on what the topic is. Could be the jobs report, it could be this news, but plenty of things to discuss.
Certainly, the rest of the day is shaping up already to be a heavy one on the news headlines.
Yeah, but hopefully it'll chill out after that because it's Friday and we hope you have a fantastic weekend. Obviously, you want to stay tuned for the rest of the news day. Donald Trump coming up at 11 and then Jay Powell coming up with his views on the U.S. economy at 12:30. This is Bloomberg.